Well, another week, another crazy market, and I brought in Jim Welsh from Macro Tides to discuss what we've been dealing with. Jim, how are you? Good to see you.
Good to see you. And who better understands crazy than a crazy man?
Okay, so I gotta talk about this from yesterday. I mean, obviously we're sitting there. We hear that Donald Trump's going to get fired, or he might get fired, and it's imminent. And next thing you know, dollar goes crazy. The bond market sells off, stocks sell off, and 15 minutes later, basically
Never
everything.
mind.
Yeah, it's refuted. Now, I'm gonna map it out how I saw it, and maybe you might want to add to this. And I know you wanted to talk about it anyway. Um, the night before last, I actually got a text from one of my best friends, and he's like, "Hey, is the Fed chairman getting fired?" And he took a screenshot of this Republican
Right.
representative from Florida, and she said, Powell's going to get fired. I heard, blah blah blah." And so the market didn't really take too much to it, but the next day, yesterday, the story gained a little bit of strength, and obviously, what happened happened. Now, my opinion, and my opinion is, there's a lot of different organizations, companies, politicians. They do this type of thing all the time. You got the Bank of Japan; they would leak something out to Nikkei about what they're going to do with monetary policy, see how the market's going to respond, and they would kind of
Trial
go from
balloon.
there. Yeah, they're just kind of probing. So you probably have Trump that's sitting in the White House going, I can't stand Powell. He's got to cut rates. I can't deal with him for another 9 months. I want to fire him. How do we do that? An aide goes, well, you know what? He's probably like, how do you think the market would respond? The aide goes, well, somebody from his administration, well, I think this would happen, but this is how we can find out. I'll just leak it out to this representative that it is happening. Word gets around, a couple articles are, released, market responds. You can see how the market's going to respond in that. And what happened is just that. And he didn't like the response. So he had to, get in front of a microphone and say, that's untrue. It's fake news. It's false. And he walked it back. I mean, when you get a market response like we did yesterday, dollar sells off, bonds sell off, yields rip, stock market comes under pressure. He's like, okay, that's a sell America trade. I don't like it. I'm gonna say it just didn't happen. Am I off base here, or do you see it similar to that, Jim?
Um, well, I think that's a reasonable way to look at it. At the same time, if this was the first time that Trump had really, been negative about Powell and stuff, I think that would add weight to what you're suggesting. That, okay, behind the scenes, they've been having the discussions. Now let's float a trial balloon. As we know, he's been negative on Powell for quite a while, and he's just raising the temperature in terms of his comments, some of the words that he's used to describe Powell and so forth. Um, to me, I just don't think it's the right approach. As I've said, I think he's raising the bar for the Fed to cut. Powell isn't the only guy in the room that votes. There are 11 other people, and they do value their independence. And so this criticism, I think, puts pressure on them to have economic data that makes it clear that a rate cut is warranted, as opposed to, gee, they're just kowtowing and buckling to the pressure. So I think it's counterproductive. As I've said a few months ago, I think Trump would be better off saying, I know they'll do the right thing when it's warranted. Just keep, but that's not Trump. And so again, I don't think this was a trial balloon type of thing. This is the way the guy operates. He likes to insult people. And, I just think in this case, it's really, um, you know, some criticism of the Fed is certainly warranted, but taking it to the next personal level, I'm not cool with.
All right. Well, the thing is I think you bring up a great point. It's raising the bar for a rate cut. And so what happens when we don't get a rate cut? And then you're going to have to deal with the market response. Jim, you
Yeah.
you brought us a bunch of charts. I want to go through them all. We're dealing with So a lot of volatility at this point. Actually,
Yeah,
today happens to be one of the quietest days that I've seen in the FX market in a while since volatility is low, stocks are ripping as we are forging out almost new all-time highs in the S&P. So I'd like to go
yep,
into some of the charts that you
yeah,
brought. So
yeah. Well, the first one was just kind of looking at the CPI report, and you and I've talked about this. My take has been is we're going to see inflation tick higher in coming months, and that by the time we get the August CPI report in mid-September, which is right before the Fed meets, I think the headline and core are going to be up at least 3/10 from where they were a couple months ago. That'll push the core rate of CPI above 3%. Um, looking for signs of tariff inflation. Well, goods is one of the, because we import a lot of goods, right? And we can see that there was a pretty big jump on core goods. This is excluding autos last month. And the other thing I would point out, you look at the annual rate of change in this measure, from late 2023 until last month, we had deflation in terms of core goods. The year over year numbers were negative. So that really did help. Deflation in goods helped offset some of the service inflation and contributed to the decline, along with the big drop in energy prices of the CPI coming down over the last 6 to 12 months. So to me, this is a hint of things to come that we're starting to see it. The other thing, import prices came out this morning, Blake, and goods were up 0.4%. Well, annualized, that's almost 5%. So my point is we're starting to see some of this bleed through, which again makes it very difficult for the Fed not to just keep sitting on their hands as they want to quantify how much inflation is coming through before they start cutting rates. And I just, this is, I think, the first real indication that you can point to that we are starting to the beginning signs that inflation is in fact starting to come into the numbers.
it's not dead, folks. It's not dead. So
No,
Jim, what does this chart show us?
well, I just wanted to go beyond, the name calling that President Trump has done with Powell, that there is some basis for legitimate basis for why he's motivated to say the things that he's been saying. So if you look at the amount of debt coming to due in 25, 26, and 27, it's about 35% of total outstanding debt. And what Trump has been saying, of course, he magnifies the numbers, save $1 trillion a year. No, Donald, unless you cut all rates to zero. Um, is that if you could bring the average maturity yield down by 1%, this is what's coming due is about 12 or 13 trillion. So if you shaved 1% off, that's over 100 billion bucks. And then you start, over a period of about 7 years. The average maturity of all the debt is 7 years. So my point is, this is where Trump is coming from, that, hey, if you can bring rates down, the government would save a lot of money. And he's correct. The problem is, the issue with credibility and the Fed cutting rates while inflation's ticking higher. That'll be kind of like sitting on your hands when inflation was exploding in 2021, and we'll see that in a couple charts. So I just wanted to show part of the
Oh,
reason. Now,
sorry.
here's the maturity
Okay.
mix of the outstanding, 36, $37 trillion worth of debt. Bills, treasury bills, that's basically paper that matures 1 year or less, 22%. Notes are from 2 to 10, 52%, and then long paper, 10 years and beyond, 17%. Now, Treasury Secretary Bessent, I believe on either the 30th or 31st of July, will be the Treasury release, kind of here's what we're going to be doing for funding in the months coming up. What's going to be interesting, Blake, is whether they do a pronounced shift and raise more money short term. I mean, are you going to want to continue to issue 10-year and long dated paper when the interest rates are at this level, since they believe they should be coming down and that their policies are going to cause rates to come down. So that'll be this interesting to see If best in a sense tries to manipulate the supply and shifting it towards shorter dated paper that then would come due more quickly. So if and when rates are down, we take advantage of it.
All right. Well, let's see if their rates would actually come down. So,
Well,
that's
that's a really good point
yeah,
because, flashback a year ago, the Fed cut the funds rate by 100 basis points. The 10-year yield was at 360. And what's it at? 440 to 450,
yeah.
you know, and it hit a high of 480, I think, somewhere in the last 6 months. So just because you cut short rates doesn't mean you're automatically going to see longer dated rates come down. This chart is, I think, to me, if you wanted to see how late the Fed was in terms of responding to the inflation pickup in 2021, I think this chart makes it really clear because you can see all the different inflation metrics. So it was pretty uniform, rising. And as we got past mid 2021, these things were pushing up to 5%. And I wrote in June of 2021 that inflation was not going to be transitory and it was going to be a problem. And it really wasn't until November of 2021 where Powell finally caved in and said, yeah, it's not going to be transitory. So you can see how far behind the curve they were in 2021 and obviously going into 2022. And now we can see that inflation by all the different measures are below the funds rate, which is at 4.37%. Now, the Fed's target is 2%. So all the inflation metrics are obviously above the Fed's target. And policy can be described, and you and I have talked about this, as being somewhat tight. If you look at the spread between the funds rate and the inflation rate as measured by the CPI, it's relatively tight. So one can make the case of why are you holding rates at a tight level? Well, again, it goes back to, well, if inflation ticks up, the degree of the real funds rate, in other words, the difference between the funds rate and those different inflation metrics is going to narrow. And we just saw the headline CPI go from 2.4 to 2.7, and I think it could go over 3%. The core rate is going to go over 3%. So all of a sudden, that degree of tightness narrows because inflation is moving higher. So again, I understand where President Trump is coming from in terms of trying to save the country money in terms of its borrowing costs. But the way he's going about it, I think, is going to be, well, so far has been counterproductive.
Well, do you
And
think
if
it's
you
really been
undermine the
counterproductive?
Fed's credibility, Blake, and you're selling a boatload of bonds, I think that doesn't make people confident that they should be buying longer dated paper if you're going to have a compromised Fed chair.
Okay, well, the stock market obviously finds no problem in it because
Yeah, yeah, we're pushing
like
up.
you tell me there's an issue, but the market doesn't see it as that, at least the
Right.
stock market.
No, it doesn't. And, as we've talked quite a bit over the last 2 months, the advanced decline line has consistently been making higher highs, which for me, longer term is a bullish, in other words, out 6 months or so, intermediate, that's a bullish thing. What I've been saying is short term, sentiment's getting a little crazy. Last week, I showed the National Association of Active Investment Managers, and the last three times they got up to the level of that bullishness, we saw corrections of 5%, and up to 9% in last year. This is the CNN Fear and Greed Index, and you can look this up and monitor it. And, you know, not surprisingly, with the S&P at and maybe making new highs again, we have extreme level of greed. So my point is, sentiment is important. And when you reach extremes, then one has to kind of be aware because we get to an extreme because prices have already gone up a lot. And everyone knows the reasons why prices have been going up a lot. And that's when you should at least worry for a modest pullback. And the next chart explains technically why I think there's a reason for it. So the AD line coming in today was about 2,200 issues below the prior high, and breadth is positive by about 700 issues. But
So
this is
so
an
this
oscillator.
AD line has changed quite a bit since last week.
Yes,
Okay.
right. But what this is a 21-day exponential moving average of the difference between each day, how many stocks went up and went down. And it's like a thrust indicator. And when it's very strong, you can see what it did during April and May. And getting above that red line is kind of like, okay, we're overbought. And when it sustains overbought conditions, like it did in April and May, it's a good message. But the S&P had a very, very modest pullback. I think it was like 40, 50 points from high to low. And yet you can see this oscillator dropped a lot because market breadth under the surface was pretty weak. Yesterday you had Nvidia up, I think, 4% because they're going to start selling stuff to China again. And yet breadth was really pretty ugly. So what this is suggesting is I think we're so close. We're going to make a new high. And for the first time in a while, we'll start to see meaningful divergences between this oscillator and the S&P making a new high. 2, 3 weeks ago, hey, it was confirming it. Week and a half ago, it was, although not quite as high, it was still above that red line. Best divergences happen when you're just below the line or, obviously near it. And so technically, this is to me suggesting that the market is vulnerable to a 3 to 5% pullback, just because it's time for a little bit of a timeout. As we get closer to August 1, it'll be interesting to see how many of these trade deals are struck, how many countries will get the 25 to 40% tariffs slapped on them. I just think there's going to be a reason for the market to potentially have some profit taking. The Fed meets July 30th. They're not cutting rates. I think we're hearing the same messaging as we've seen for the last three meetings, probably. We're waiting on the tariff inflation, and the economy is doing well enough that we can be patient. That message isn't going to change. So those reasons could just, again, allow the market to have a pullback.
All right. Well, you've been pretty bullish the last couple of weeks, so this is a little bit of a change from Jim
Yeah,
Welsh.
yeah.
And let's see if we have a little bit of a change in how you feel about the Treasury market here. So what do you
Well,
think?
longer term, as we've talked, Blake, I think longer term Treasury, the longer term trend, the major trend is up in Treasury yields. And my take here is that we're going to see the 30-year get above 515. Well, why is that important? Well, a month or two ago, it got to 515. That also was the high in October of 2023. Globally, we're seeing 10-year yields go up across the board. Japan, Germany, France, so this isn't just the US market on its own. This is a global phenomena that's happening. And I think if and when the 30-year gets above 515, the comparable number for the 10-year is 5%. But I think it getting above 481 on the 10-year will be kind of like, whoop, why? Because that was the most recent high we've seen. So I think one of the reasons why the market could pull back and why reason people will have a reason to take some money off the table is if we continue to see treasury yields work their way higher, and especially if the 30-year gets above 515.
All right, all right, very good. The dollar, obviously we had a heck of a response yesterday, but then the dollars come on back because it looks like, at least for now, the Fed chair is going to stay the Fed chair, and the dollar just is continuing grinding higher. Do you think this has a chance of accelerating higher, Jim?
Well, again, I've been bullish. I've been saying that we're looking for an important trading low. And over the last few weeks, we've talked about, well, slowly but surely, the pieces are falling into place. As the dollar dropped to 96.37, the RSI recorded a very large divergence. It was like 31 versus 21. The 5 and 13 moving averages, the red and green lines have turned positive. Just the most recent, downtrend that the dollar has been in since that high of 101.97. Well, the last couple of days we're getting above it. Now you also see the RSI is it's not overbought, but if we get up towards that 99.42 to 100, short term the dollar will be a little bit overbought. So is there a chance for a pullback? Yes. The other thing that I haven't heard anybody talk about. 2 weeks ago, Besant was talking about wanting a stronger dollar. And a week ago, Trump said the same thing. Now, whether or not they mean it sincerely, the point is that's a change in the messaging. And for the first time in quite a while, it showed up. So people are really bearish the dollar. Sentiment, is very negative about the dollar. So that means people are short the dollar, long other currencies. Positioning reflects that. So I think potentially, Blake, and again, my take is a rally to 105, 106 is coming. And the nature of that rally will tell us whether or not there's a rally up to 110 coming.
So
So
just
that's my bias.
and let me, before we get into gold really fast, for those of you at home, if you're not following along, look, Jim was bearish the dollar when we were up at 108, 109, and I didn't see it. And he's like, "Oh, we're gonna jam back below 100 into the 90s," and I'm like, "That's pretty bold call." And boom, we did, and we have. And fortunately, I've been on the same side as Jim, running the dollar higher over the last 2 weeks, which has been great. But if you appreciate what Jim does here, make sure you give him a thumbs up. Make sure you comment down below, especially if you have any comments about if you think this the Fed chair. You have any thoughts about the Fed chair and should he stay or should he go? Jump in the comments, but make sure you give Jim a big thumbs up. Okay, now I want to go into the last chart you
Yep.
brought, Jim, and I want to go into gold because everybody wants to know how you feel about gold. So you've been looking for a drop. We are just challenging some support here, but it's been holding this trend line. So what do you think?
Well, I think it's going to take it out. My take is that once gold got to 34.96, we were going to have a pullback. Had a very sharp drop to 31.27. And the way the pattern has evolved since then looks like a potential triangle where you had a very choppy rally up to 34.49. I think, as I have on the chart, a C wave that I expect to take go below 32.56, but hold above 31.27. And if we get a drop below 3,200, Blake, I think the RSI on gold will start getting closer to 30 and be somewhat oversold. That then should be enough to launch another choppy rebound in gold. The alternative is gold's going to take out 31.27. So I'm still of the mind that the correction has either more in time to go, in other words, more choppiness without a lot of price erosion. You don't take out 31.27, or we're going to get a quick puke and it gets below 31.27, and then that will be the buying opportunity. Whether it's the sideways chop or the drop below 31.27, once those pieces in place, I'm expecting gold to rally above 34.96. So longer term positive, just trying to navigate what's been happening in recent months, and I think it's going to continue for a while.
Well, Jim, you've been spot on with your market calls, so I want to thank you for that. And guys and gals, if you appreciate what Jim does here, like I said, make sure you give him a thumbs up. Jim, what's the best way for traders to follow your work?
Macrotides.com, or send me an email, Jim Welsh Macro at Gmail, and I'll send you a recent report.
And then also just tell Jim that you are a listener here at Trader Summit. He'll give you a discount if you're really interested. So, Jim,
Absolutely.
I guess, last question I have for you. What are your opinions on the Epstein files? I'm joking, joking, joking.
You know
Joke.
what? The whole thing is kind of a joke at this point in time
Yes.
because it's ironic. President Biden had those files, did nothing with them. The Democrats never said anything. If there was something incriminating, given the way the Justice Department behaved against Trump, I think they would let that cat out of the bag way before the election in 2024. And, you know,
Yeah,
so
but
to
it's
me,
not.
it's interesting that now the Democrats are, yeah, man, he must be in it. Well, really?
No, I don't think that has anything to do with it. I personally think, and I shouldn't be running down this road with you, Jim, but
Ha!
you know, people have the right to know. Trump's probably not in them. You're right, but the White House is looking at it probably from you're going to wreck so many people's lives. However, I am in the camp that they did it. They should be, I don't care if it's Prince whoever and it's King
Yeah,
whoever and it's
it's serious.
ex-president whoever, they should be responsible. And I think that's where, the White House is like, is it going to be too big of a bombshell on too many people? And even
Just for
though,
what it's worth, this week, Dershowitz, who was what's his name, attorney,
yeah, 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 yeah.
Epstein's attorney and stuff, and he said, "Hey, there was no list. That the quote unquote list came because of FBI interviews with different people who had been maybe victimized and so forth." And so he threw kind of cold water on it, and that Trump wasn't involved. He's familiar with all that stuff. But the key point he made, Blake, which I think is the key point, was that there were judges in New York that basically put a lid on what could be released. And so, to some extent, what's happening now is that the FBI has their hands tied based on what judges have already ruled in terms of releasing that information. Now, again, I have no skin in this game. I don't care. I just thought Dershowitz's comments, as somebody who was on the ringside view of the whole thing, had a slant that I haven't heard anybody talk about. That there's judges that have put a clamp on the release of that information.
Well,
So,
Jim, my whole point of view, and we're gonna cut this out,
yeah,
cut the interview out, excuse me, is that the problem with this is, and the point I've been making to our community is this really is a market related incident because as the attention is focused over here on Epstein, Donald Trump being Donald Trump is going to try to take the focus off by doing erratic things like what we just saw with the
with Paul.
dollar and the Fed chair and
Yeah,
trade announcements, things that can really affect what you and I, all of us, do in the markets, and that is not the joke.
no,
Joke might end up
no,
being on us. So anyway,
you got it. All
yeah,
right.
Jim, it's been a
Well,
great
I'm
one.
so glad we saved the best to last.
Yes, right. I shouldn't have even gone there, but I did. Jim,
All
it's
right.
great. Always great meeting up with you. I know we're going to see you on the Face Show, I believe, tomorrow. So if
Yes.
you guys don't listen to our sister company over at Forex Analytics, and Jim will be on with Dale Pinker tomorrow.
I've
Um,
known Dale since 1990, so I'm really looking
19.
forward to chatting with Dale.
Yeah, that'll be great. All right, Jim. Well, great chatting with you today. Have a good one, and I'll catch you next week.
You got it. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.